Okay, we're back. Today is, I don't know what day is it, June 5th. We had our interest rate announcement, the best interest rate announcement we've had in what, 3 years? And we've
4
had
years.
a drop for 4 years. Yeah, thanks for the correction. 4 year, the best interest rate announcement in 4 years today, June 5th. And we're coming at you live with some perspective on that with Hugo Dos Reis from Vine Group and Rizwan Qureshi from EQ Bank. So this is the first time Rizwan and I are getting a chance to meet, and seems like he knows what he's talking about. So why don't you just give us a little intro on who you are and kind of what you do, and then we'll jump in.
Yeah, well, so my official position at Equitable Bank is a business development manager, and obviously Hugo and Buying Group are one of my accounts I do service and take care of. But broadly speaking, I've been in the industry close to 20, 22 years. Multiple lenders from the underwriting side, from the mortgage officer, doc fulfillment side, and now to the sales side. And you know, hopefully Hugo can attest to this, is the value that I bring to my accounts that I take care of is just my experience and the knowledge that I have that I've built up over the years working for different lenders, right? But yeah, that's kind of like a short snippet of me. Yeah.
Okay, cool. And Hugo, I think our audience kind of knows you, but briefly, I mean, you're pretty
Yeah,
experienced mortgage brokers.
I'm a mortgage broker, one of the founding partners at Vine Group, which is a national brokerage. We're pretty much all over the country. And, me personally, I've been really involved with the investor community and putting together strategies and financing options and building portfolios and, navigating all the different changes we have, with investors. And Equitable Bank and Rizwan and his team. Rizwan's great because he really understands investors, and they're one of our lending partners that we use quite a bit, for certain clients, and really, really investor friendly for sure.
Yeah, and before we get there, Equitable Bank, uh, do they do A and B lending type or just a B lending? Like, where do they
So,
fit in?
so at the end of the day, to give you a nutshell of who Equitable Bank is and the strategy, I mean, we are a Schedule A bank. We have close to 115 billion in assets, right? Uh, but typically when you hear about the top five banks, usually Equitable Bank is never mentioned, right? But we are a Schedule A bank. As far as our product suite or what we call ourselves is, we call ourselves a challenger bank. And the mindset there is we want to do something that's a little bit more niche, that's a little bit different, that caters to the immediate market and the needs in the market, right? Rather than following suit and doing what the typical top five banks do, right? So that's kind of like our mantra and our mindset. But product wise, I mean, we have insured insurable lending, we have our alternative side, we have reverse mortgages, we have small commercial, large commercial, we have deposit services. And, a few years ago, we started lending on cash surrender value as well. So we lend against life
Mm,
insurance too, right? So,
cool. All
yeah.
right. I got a life insurance policy. Maybe we'll chat.
Yeah.
Okay. So you guys, so to sum it up in layman's terms, I guess you're not following whatever the big banks are doing. You're sort of finding the opportunity with whatever landscape is being presented and sort of filling that need.
Correct. Correct. Yeah.
Okay, that makes sense. And with 115 billion dollars in assets, I'm sure you guys are filling lots of needs out there. Okay, cool. All right, well, let's jump into it. So yeah, we had a quarter point drop. Thank God.
Yeah.
I think it was well worth it. I heard some news from some economists, and I should have saved the article from the States that saying that Canada's in a position where they really have no other choice, and that they expect further drops, maybe not in succession, but further drops over the next 12 to 24 months. Is that kind of where the you guys are thinking too? Like, what is there a difference at all?
Hugo, do you want to go
I
ahead?
could, I got a couple of comments. I mean, just in what we've come across as well and what we've learned. A lot of the chief economists of some of the other big banks, are kind of looking at the data and saying that we might see rates drop a total of 1% by the end of 2024. So we've already had our first one, and
Mm.
depending on the impact of that rate to some of the data that we've been seeing, which is hasn't been too strong. Yeah, I think that's very realistic to see another 75 points of rate drops by the end of the year, and then an additional 1% drop by the end of next year. And that's
Yeah.
coming from the big bank economists at RBC and CIBC, who put out some recent articles just about a week ago. So, that's just looking at the data that's out there. The economy is pretty stagnant. Inflation has come down quite a bit. And if you take out the energy costs and the cost of borrowing, like inflation is actually quite low. So we're not really growing very much. And there's a huge strain on businesses and homeowners and so on. So I think this is definitely warranted, and there could be a lot more. And yeah, so I think it's really, just be mindful as to what type of solution you get into, knowing that, hey, a couple months from now, rates could be a lot lower, and you don't want to lock yourself in too much.
Yeah, I feel the same. Why I was mentioning that, and I've heard that from obviously the Canadian side, but it was interesting to hear from the US side looking at us, and they're like almost like a no-brainer. These guys have no choice but to kind of come down. Yeah, and the other part of that from the Canadian side is that if you remove all that carbon tax nonsense, and the extra interest rate, that our inflation it's almost negative, like depending on how you calculate it,
There's
which is
very little
insane.
growth. I think aside from the immigration, the growth is pretty stagnant.
Yeah, they need real estate. Go ahead, Rizwan.
Yeah, no, and just looking at it globally as well too. I was watching news a couple of days ago, and I think Europe and London are looking to drop by 0.25% too sometime soon. The Fed, on the other hand, they might hold out a little bit, but it's really interesting to see that even though the rates went up so fast and furious, economists and even the Bank of Canada relatively, they're looking at the housing pricing, right? And yeah, they did drop a little bit, but not as much as they expected, right? So to Hugo's point, in the sense that, a lot of them are forecasting maybe a 1 point drop by the end of the year. My personal opinion is I think it's going to be 50 to 75. It's going to be a little bit more conservative because you also have inflation reports coming out over the next month or so, right? That might have an impact on the July 24th announcement that's coming up too, right? So to be honest, I mean, I think we just have to take it day by day. I mean, I'm happy that they dropped the rate right now. It definitely adds to the consumer confidence. And the business that you're in, the one that Hugo's in, that I'm in, it's all about consumer confidence, right?
That's right.
Now, it's not gonna, a quarter point is not gonna be a huge impact or a dent, but the confidence is there. Now we're in a downward cycle. So, even though if they don't drop 1% by the end of the year, but at least by the next year, there's gonna be that confidence and the momentum is gonna grow, right?
I've been saying that for a long time, and just from, without not in a scientific way, but even if we can make deals work on the cash flow side, it's people and investors, they can't predict what's going to happen in the next 3 to 6 months. How can you gamble on a 3-year or 5-year mortgage? Like, we're not sure if we're going to World War III or interest rates are going up or down. Like, you need to have you need to be able to forecast at least 12 months to have some confidence to make a move. And people haven't been able to do that. So I don't even blame people for sitting on their hands. So I think if we get another drop in July, I think it would really spark some confidence and get transactions rolling again, which we all want.
I think also the major difference is what type of client you're getting. I mean, with us, obviously the first time investor is going to be a lot more hesitant, right? As the experienced investor has a large portfolio, maybe a little bit of cash flow, they may be a little bit more confident to pull the trigger, right? While the rates are high, because they might be able to cash flow, right?
So some of them are, but a lot of them, and me included, like I did some buying like kind of early on in 2022 when things were going up like crazy and prices kind of had that big initial drop. Like we did well, but since then I'm like, I'm not buying anything until I see a screaming deal, and I haven't. Right. So some people are just sitting on the sidelines and waiting, and I think this is a good spot. So if I was an investor, and let's just scenario here, and I'm curious on both your opinions, and I'm new. It's my first deal. It's my second kind of thing. I'm just getting into the game. I know I need to have real estate in this country if I'm going to survive financially in the next, 10, 20 years. And so I want to make my move. Like, from a financing lending perspective, is it a good time in the next 6 months? What should I be looking out for? Should it be a variable, a fix? I'm just curious on your overall opinions.
So I mean, theoretically, the way I approach it is if you, whether you're an experienced investor or first time investor, what I would ask them is, what's more important to you, the rate or the month to month cash flow, right? And then based off of that, you're able to kind of direct them into what kind of term you want to go into, fixed or variable, right? Uh, so, it's really a hard question to answer in a sense because you need to know the client's ins and outs and as far as their stress level, like how far can they bend it, on a monthly cash flow basis, right? Because to be honest, a lot of the investment properties at the end of the day, the interest is a tax write-off, but to a lot of people, it's the month-to-month cash flow, right? If they're not able to pay the mortgage, right? And I'll give you a perfect example. During COVID and when the rates started going up 2 to 3 years ago, there was a huge influx of clients buying secondary homes, cottage properties, right?
Mm.
They were going out there, they were buying them up like there was no tomorrow. And surprisingly enough, well, it wasn't really a surprise to us, but last year we had quite a bit of defaults on the secondary home
Really?
and on cottage country, right? Because
Really?
naturally speaking, when cottages, different dynamic because at the end of the day, you're gonna put it up on Airbnb, you're gonna get short-term rentals. You're not gonna get a lot of long-term tenants in there. You may get some, but not a lot, right? Um, and if you fall into money troubles, rates start going up, you can't cash flow, you're gonna start undercutting the market, selling it for cheap, foreclosure and so forth. So we saw quite a bit of that on the secondary home segment and the cottage properties, right? So
That's interesting.
yeah, from a lender's perspective, look, going forward and someone's looking to buy an investment property, I'll definitely take into account, their current situation and the cash flow aspect of it, right? As far as the rates coming down, yeah, the trajectory is going to be there. It is going to start coming down. It's not going to come down as fast as it went up, right? So, my opinion is going to a 1 or 2 year fixed and then you can revisit it. Or if you're the type of investor that's looking for a short-term solution and they might sell it at the right price or they might renovate it, flip it, then, obviously you got the variable option, right? Which
Yeah.
yields you a cheaper rate, right? So
Yeah.
that's kind of like my perspective on it.
Got it. Got it. And I mean, any difference from you, Hugo, or are you kind of similar?
Yeah, I mean, I probably have a slightly different view on it. So, my perspective is, look, naturally when rates come down, asset values will go up. You know, that's usually the case. So a lot of the conversations we have is, I don't want to buy right now because rates are too high. So a very basic illustration is like, let's say you're getting a $500,000 property, just to kind of use a safe, easy number, $500,000 property. Let's say the rates are 7%, and I'm being really conservative, right? 7% rate, and you don't want to buy because you're going to be cash flow negative. Maybe you're cash flow negative $500. Let's say you're cash flow negative $1,000, for example. I would argue, well, if rates do go down, you know, to 6%, 5%, which we're already seeing these rates, by the way, values will start to creep up. So my I guess feedback to them is like, let's say it's going to cost you an extra $10,000 of interest. So $500,000 at 1% interest is about $5,000. At 2% interest, it's 10 grand. So let's say you're saving $10,000 of interest if you were to wait. What is the likelihood that $500,000 asset is going to be worth more than 510 by the end of the year? Very likely it'll go up more than $10,000 over 12 months with a rate drop of 200 points. So my argument is exactly that, is if you could afford the payments and you can manage the shortfall that you're going to have, and this fits within your overall plan, and we could put a financing strategy that's like short term, maybe 1 year, 2 year, whatever, then do it. Like, because that $500,000 asset is probably going to be worth 550, 525, or whatever by the end of the year or earlier, and now you're paying even more despite the interest rate cost. So I think sometimes people get so caught up with the rates, and it's just like, just do the math. The math is black and white, and that should dictate. You shouldn't build a portfolio on multiple negative $1,000 properties, but I think there's something to be said in buying right now at discount.
Yeah, I believe it or not, I just wrote a book. With all the ADD I have, I concentrated and actually wrote something, and I talked specifically about this.
Page. It's one page.
Yeah, it's 56 pages with charts, but like 56. And I spoke specifically about exactly what you're saying, and I mean, it's the old saying that marry the property and date the rate. and you're supposed to be buying when there's blood on the streets. And I think that's a lot. What you're describing is a lot easier for people who have some experience. For new people, like it's like they can't sleep at night if they're losing $1,000 a month. And I mean, we're all preaching to never do that. So it's hard to, push them to do that. And you got to have some serious, let's just say you got to be very brave to do it on your first shot. But it does mathematically make sense. Like, in practical terms, we've had several people who already have some experience do this with some multifamily, both in Kitchener and Hamilton. And we've been, for example, one guy, he picked up a nice fourplex, big kind of Victorian style, just under 800 grand, like 780 something. And, he's going to do a few renos, and the rents have not dropped like at all, like between 0 and, 5% drop, let's say, depending where you are, but essentially zero since this all started. And that same property 3 years ago would have easily sold over $1 million. So he's picking that property up 20% less than, let's say, the peak. And if he just rides it out over 5 years, that property is going back. And now he's going to get the cash flow he's going to get at 800 grand versus $1 million. Like, it's a no-brainer.
Yep.
So I think if you have cash and you can stomach that, and the way we did it was, okay, it's 800 grand, 200,000 set aside for your down payment with closing costs and land transfer tax and all the other stuff. Take the 2 years of interest, because you took a 2-year term.
Right.
Calculate the negative cash flow, put it in your bank account now, make it part of your down payment. So put in the extra 16 grand in there, and it's there, and you're done. Right? You don't have to wake up and worry about it. And he had the money anyway, so it doesn't make a difference.
I've been suggesting the same thing. Exact
Yeah.
same thing is look, ride it out for 2-3 years, like cover the shortfall somehow. And, let's make sure the math still makes sense after that time frame. So yeah.
Yeah. But for first time people, and I'm always, I got a soft spot for first time investors. I used to be one, 2010. And without buying that stupid bungalow in Hamilton for $238,000, I would never have been here today. Like, I bought my first one when I was 24 years old, and I took a chance, and it ended up being a crazy story, which we don't even have time for. But that propelled me forward. And if you don't get into your first property, you can't ever have more than one anyways, right? So we got to get people doing it in the game, right? I feel like I got to recruit the first time investor. And so I feel like it's scary for them. So like, what's your, Hugo, just, off the top of your head, like what's your advice to these people in the next 6 months, 12 months even? Like, if you have the cash or you have some line of credit, like, where do you look at? If you live in the city, for example, should you invest in the city? I've been telling people, if you work in the city, fine, work in the city. I'm not suggesting you move. Keep renting. Buy a property in Hamilton or Barrie or Oshawa or whatever. Just get in the market. At least you're renting and owning somewhere else. Like, I'm just curious what you guys are thinking and saying from the bank and mortgage broker perspective.
Yeah, well, if I could throw it out there, because I speak with a lot of investors in different, types of niches. I know you guys have a niche, but there's investors that they're just like, I want to get into a condo. I know I'm not going to make any money off this, but I just want to have that one condo. My kids are going to university. In my mind, it's my way of like helping to fund their tuition because they'll be able to keep it and sell it later. So there's lots of different needs. I think it's really just finding the comfort zone, like obviously in like a blue chip type market like Toronto, Vancouver, or so on, the values are a lot higher, and turnkey type properties where you just buy and rent, you're probably not going to make too much rent off it, if any. Generally, you're buying, making improvements, adding a garden suite, a laneway house, and maybe you can break even, that sort of thing. But that's a much higher price point. Either you're a more of a heavier risk taker, or you're just comfortable putting that kind of money. But if you could deal with that, then get into that asset. Like, I would say if you had the option to get into any market, get into maybe a blue chip type option, because I think over the long term the risk and the fluctuations on values are probably lower, but cash flow is always king, right? And getting to some of these second or tertiary markets, I don't even know if I'm saying that right. There's a lot of tertiary, there's a lot more value and potential cash flow with these markets, but it's a different tenant profile, right? It's just a different type of tenant that's going to be there. So if you're comfortable hiring a property manager or just doing it yourself, and you're okay with the different type of tenant profile that you're going to get, and that's the whole lifestyle thing there. So I think it just comes down to being confident with the math, understanding the risk of the market you're in, but also having a really solid team. You guys do an awesome job sending us files that actually make sense. unlike a lot of other brokers who are just shoving stuff down clients and saying, like, listen, this 300 micro condo is going to cash flow all day long for $1 million. Like, it doesn't make any
Yeah.
sense.
Okay.
I think you have to have some confidence in your team, with the financing plan, with the real estate team, maybe a property manager, all that stuff. Yeah. So again, it really just comes down, because I have clients that have convinced themselves that a condo is the way to go, and other clients are like, I'm going to buy this $2+ million property in Toronto or Barrie or whatever. So everyone's different, has a different opinion. You just need to be comfortable with it and sleep at night, with that
Yeah.
decision.
Yeah.
Yeah.
Yeah. Go ahead, Rizwan.
So, I mean, Hugo hit the nail on the head, right? And as I was alluding to before, it's just the client's own personal preference and the risk tolerance that they have, right? Some clients, first time investors, are like, I got a ton of money. I want to buy downtown. I want to get in with the big leagues. You get those type of clients as well too, versus you got the clients that just want to, test the waters, and, they're a little bit more conservative. And look, I mean, there's certain markets, you can still make a ton of money long term. Fergus, St. Thomas, like these smaller markets, if it's a first time investor, they could test out the waters there. And then once they generate a little bit more income, and then they could look at some of the other markets, right? So,
Yeah.
as even as an Equitable Bank, I mean, we have different programs where we ask them to leverage. We've seen a huge trend in kids still living at home in their mid-20s, mid-30s, but they want to buy investment properties, but they want to continue living at home, right?
Yeah, I would too.
Yeah. So we see a ton of that, right? But then, we saw the niche in that. And one of the things that we also presented, a product that we brought out, was the reverse mortgage, right? It's no longer for just pensioners, right? Like, you have a lot of parents dipping into, their homes, tapping out on their equity to help out their kids to start their portfolio, right?
Yeah.
So that's, we kind of see that as well, but definitely seeing a lot of first-time home buyers or first-time investors that are still living at home with their parents, right? So it's different market.
Yeah, my big thing is, you guys are like risk tolerance. Before I even get there, I'm like what can you even afford? Like, never mind your risk tolerance. Tell me what you can afford first, then we can worry about risk tolerance. So if a kid living at home, like, how much can you possibly be making? 100 grand, 150 grand. Like, can you afford 1.2 million? Probably not, right? So if your approval limit's at 700,000, you're almost priced out of the city anyway, right? So, like, what's your choice, kid? Stay here and rent and throw your money out the window and make me rich, or keep renting but buy a property in a secondary market and be in the game. Maybe one day you can sell that property and come back to Toronto, right?
Exactly.
It's better to be in the game than just sitting there trying to save. You're never going to save up money than the market's going to appreciate. Impossible, right?
Especially if you're salary employed. Yeah. I mean, that's a good point,
Yeah.
actually. I think there's a bit of a stigma. Like, I have a lot of clients that are like young professionals. Maybe they're making 150K combined, two people, right? Out of school sort of thing. They've got a little bit of money saved up, and they want to live in Toronto, but they can't find anything that meets their needs, but they also want to get in the game. Sometimes I say to them, listen, you can only afford a price point that's going to require you to move outside the city. So, but you want to live in the city, you want to be next to everything. So why don't you just keep renting and just buy a place, just like you said, outside the city, get in the game.
Yeah.
Not only will you be an investor, you'll be accumulating equity and building that there, but you can enjoy, the city and all the amenities that, is what you're looking after. And perhaps down the road, you can refinance that and then maybe get into the property you're looking for, or you just sell it or whatever. But like you said, get in the game. I mean, sometimes I tell people, like, just grab a dart, throw it anywhere on the map in Southern Ontario, and you'll be fine 10 years from now, right? Because there's constant immigration and demand for this.
Absolutely. I don't mean to go out to left field, but I constantly see those young professionals, because I work with investors over long periods of time, right? We're doing my investors, typically we're doing 3 transactions with each other over, 3, 4, 5, 6 years. And their needs always change. So they start out as young professionals, but then they become a young family. So you have something in Toronto and they're like, oh, get me out of here as soon as I have kids. I'm like, well, then why do it in the first place? Get your investment and then just live where you got to live. I mean, there's lots of options. Anyway, we don't have to beat that horse. So, with people with money, I'm seeing a trend, and I'm curious, I'm very curious on this perspective is anybody with a lot of equity is wanting to take some of that equity off the table right now. You know what I mean? People with 5 properties plus 5 to 10 properties, let's say they got, 3, 4, 5 million dollars just sitting there in Southern Ontario, that was appreciating extremely well over the last several years. And now things have kind of unstabilized. There's a little bit of instability in the government and where Canada's going in the future. People are wanting to take some money off the table and sell. So we're seeing a lot more listings versus a lot more acquisition, which is very interesting because we're always in the acquisition mode, right? At least 70-30. And people are looking at the US or looking just about anywhere else for options. But and that's fine. And obviously I might be biased because I'm a realtor here, but I'm just saying, hey, like don't, this is not the end of the world. We go through cycles. Like it's just not always going to be happy days for every decade. Like we're gonna hit some bumps in the road. It doesn't mean that the country is going to collapse and we're going to get bombed. Like, you know what I mean? So you got to take some money, take some cash off the table. That's fine. It's especially if some of these assets are terribly inefficient. If you have a single family home that's making $3 grand a month and there's $600,000 in equity there, it's probably time to sell that property. It's probably a good idea. Whether it's we're in this time or not, you can buy 3 properties with that. It's crazy. But I'm trying to tell people to keep some money on the side, do your deal in Costa Rica, whatever, make yourself happy. You've earned it, right? Do what you got to do, but keep some money on the side because I think we're going to see another wave of opportunity here as rates come down and stabilize and transactions and start to flow again. I'm curious on what you guys are seeing on that front with some more people with equity.
Well, I mean, with us, it's quite the opposite from a lending side. We're actually seeing clients with large portfolios looking to tap into their equity,
Really?
right? So that's kind of like the trajectory we've been seeing from mid last year until now. Majority of the clientele that we see is either they're refinancing or buying investment properties, right? There's a little bit of a smaller percentage, just shy of the rental portfolio that we see owner-occupied properties, first-time home buyers. But majority of the stuff that I've seen come across play, especially this year, is all rentals. Is all rentals, and refinancing, tapping into the equity. The challenge for them is obviously the cost of funds and qualifying, right? The rates and the stress test, right? There's quite a few of them that are parked with privates and mixed with the higher rates, and they're also looking at a refinance, get into a cheaper cost of funds, so they could like leverage themselves a little bit more. So we've seen a little bit of a different dynamic. We've actually seen an uptick in the rental segment, right?
Interesting.
So, yeah.
And what, if you don't mind me asking, like what type of properties? Is it just single family, small multifamily, big multifamily?
So you're gonna like this. It's Sarnia, it's London, it's Hamilton, it's the secondary markets. If it's Toronto GTA, we're looking at condos, right?
Yeah.
We've seen a lot of Waterloo condos. We've seen a lot of even though we don't do student rentals, but we've seen a lot of condos being purchased around universities, right?
Yeah.
It's more of a secure investment. But as you get closer to the GTA and downtown core, it tends to be more condos. But as you get a little bit further away, you get the single family dwellings and so forth, right? Yeah.
Yeah. Yeah. That's very interesting. Yeah. That's really interesting. How about you, Hugo?
I mean, I'll speak on like personal level, but also on national level, kind of because we see a lot of the data for our agents across the country. Obviously, qualifying is a problem. We're qualifying people at 7+ interest rates, more or less, depending on the lender. So getting into a mortgage is much harder because we were qualifying people as low as like 2 point whatever the rate was a few years ago, right? So that's a big delta in terms of how much your borrowing power goes. So refinancing is has been huge for us. So typically, and I guess in our world, it's like 50-50 almost, at least in my world. 50% of the business is refinancing, consolidated, taking on money so I can buy more stuff. And the other 50 is purchases, right? Especially when you're working with investors, they're always trying to flip their portfolios, unlock money to buy more. And the demand is there. I would say almost all the investors are like, I want to buy more stuff. This is an opportunity. In general, they're pretty optimistic. It's just qualifying is trickier. So, not the traditional banks may not want to give you money because you've got too many properties, we just don't qualify. And then partners like Equitable Bank and others are more willing to take a look at these portfolios and come up with creative strategies. Sometimes you're sending a file to Equitable Bank for a year or two just to kind of get the deal done, given the higher rates. And then after rates come down or maybe rents stabilize, you move it to maybe a cheaper type lender option. So yeah, the demand is there, I would say. It's just qualifying is harder. So we're having to be more creative, and we probably have done an uptick in business with alternative lenders like Equitable, for example, because a traditional client who would have normally done it at a bank just doesn't qualify. And they're okay paying a little bit more, getting it done elsewhere. And this is why, because of
that was my next follow-up question. Like, I understand the need for refi, and we breached that option when I'm talking to all these investors with equity, but it seems like they're running into brick walls with whatever lender they've already with, and typically a big bank. So I guess from our introduction to Equitable, that's where an Equitable might step in and be the alternative who's going to look at the portfolio in a different way.
I think it's just being open-minded, right? Like a lot of people, again, they're so caught up on the rate, like, oh, my bank's gonna give me this 5% rate, but you're charging me a little bit higher of a rate, and I have to go with it. I want to deal with like a bank, not in their mind what I haven't heard of or what I don't see on the street corner, right? And first of all, Equitable Bank is a bank, and there's many other types of alternative lenders as well that do similar types of things. But they've been really big leaders in trying to be creative and come up with solutions and products that are actually more timely versus the banks, which I think are almost always backwards. As a super random example, like when micro condos started coming out, anything under 500 square feet, a lot of the banks were not touching those at like very high loan to values. They wanted you to put more money down.
We're financing 65.
Exactly. But now that micro condos are almost a normal part of a big city, the banks will finance those, and they've become a little bit easier. Things like Airbnb income has been a challenge. A lot of lenders have gone okay with that. So they're a little slower. And I've always found that Equitable Bank's been a little bit ahead of the curve. So when it became harder to qualify, they all of a sudden became a very attractive solution. And it's really just a conversation with the client saying, listen, client, you got good credit, good income, good net worth, all that stuff. But the ratios, the way the rates are based off, you just don't qualify with a big bank. We have a couple of really, really attractive lenders that can get the deal done for you now. Let's get it done. And then maybe build a plan where we either stay with them long term, or we get you back into maybe a lower rate solution down the road. And so that's just knowing what's out there and working with someone who has access to those options and is educating you, I think is the difference.
Yeah, just an interesting thing popped into my mind, with lenders like Equitable. I feel like people in Canada, they're just, it's not a risk adverse thing. It's just, I find like as soon as you get away from the big five, it's like scary. It's like, oh my God, what is this thing? And I'm doing a lot of research in the US now, and it's totally normal there. Like, just like, I don't care, give me the loan.
They've got dozens.
Even just give me the loan.
Broker.
I think
like, this boggles my mind. I'm like, give me some of these clients.
Well, see, I think I had a conversation with another agent a while ago about this. The US has like over 500 banks, right? And Canada,
that sounds about right. Yeah.
Right. So I mean, even you look at our airline system, like there's a lot of monopolies, even telecommunications, there's a lot of monopolies in Canada, right? But having said that, like we would love to be more competitive, but at the end of the day, we've got a smaller playing field, right? But that's why I mentioned before is like we're trying to find the niche in the market to concentrate on, right? And to Hugo's point, micro condos, believe it or not, when the banks were turning them down, we were accepting them. Our minimum square footage on a condo that we'll go to is 325 square feet.
Interesting.
Right? Yeah. So
I just looked it up. It's actually 5,000 banks in the US almost.
Oh yeah,
so like
there you go.
It's a completely different market. Like we've got like you guys said, like a very almost, I don't want to say a very immature market. It's just so concentrated with so few banks, and people have been sort of brainwashed to some extent that like these are my only options. And I think just understanding, like I have clients that are like, this is a better rate, way more features, way more flexibility, but it's not on a street corner. Like, I really want this color here. I'm okay paying a premium. It's like, it doesn't make any sense.
Green and blue and red. Oh my God. I think that's just business training. Like the more experienced investors get, like the more they realize that if you're going to continue to accumulate properties, like you have a business here, and if you're making emotional decisions in your business because you like blue versus red, like it's silly. You're not going to go anywhere. But
Yeah.
we got to get people over that hump first. Okay, now I just had to plug in my computer there. Just in terms of rates now, just I feel like we should have talked about this at the beginning. So we dropped a quarter point on prime rate from 5 to 4.75. So what does that mean for variable now? So everyone's variable rate is going to
Yep.
go down by a quarter point, correct?
Correct.
Right. I know it's
Well, for the
obvious to you
most,
guys.
that's the expectation though, Paul. But I remember when rates were coming down the first time, and some banks, I won't say their names, didn't sort of give you the full quarter percent. They kind of gave you a little bit less. So the expectation is across the board, and Rizwan, and you can speak on your bank, I guess,
Yeah.
like I would expect a quarter percent. But again, historically, that wasn't always the case. So just to be
Yeah.
safe.
So as of, I think, 3 o'clock today, our prime rate 6.95. So we dropped it a full quarter, right? So yeah, there's certain banks, but then again, it comes down to their spread, right? Like certain banks have different thresholds, different cost of funds on how they raise funds and so forth. But with us, normally when there's a rate drop on prime, we'll reflect it the exact same way on our end. So we dropped our prime rate to 6.95, which means all the lines of credits, everything does drop as well. On the positive side of things, for investors looking to now maybe pull the trigger, maybe that quarter point and that the lowering of the interest rate on their line of credit will now allow them to tap into it where they could cash flow and purchase that investment property, right?
Yeah.
I don't think it's going to go 0 to 100 right away, but you're still going to get a small segment of those investors now getting a little bit more confident in pulling that trigger, right?
Okay. So a quarter point drop should mean that your variable rate's coming down a quarter point, or your HELOC rate is going to come down a quarter point. But the prime rate drop doesn't necessarily. I know you guys know this, but we're saying it for everyone else. The quarter point drop doesn't necessarily affect fixed rates. That's on the bond rate, correct?
Correct. Yeah.
Yeah, that's a really, like, we just had a whole meeting with the team because I got a bunch of emails saying, "Hey, my fixed rate is quarter percent lower, right?" Which is not true. So if you actually look at the bond yields, you pull up any just type in like 5-year bond yield Canada sort of thing. There's a graph. You can look at the graph, and there's fluctuations in the prices of bonds, and that's generally where fixed rates are priced off of. If you actually look at the recent bond yield for a 5-year, it actually has dropped. I think it's like 30 or 40 points. It's like been pretty aggressive in the last couple of days. There's a lot of expectations for a rate drop, but we're pretty much sitting where we were, I think, in April or end of March, somewhere around there. So we're kind of back to where we were a few months ago. So in that time, rates have actually crept up a little bit, and rates have kind of more or less stayed in the same sort of range. So
It's been fluctuating basically level for a while, right?
yeah,
Yeah.
it's been kind of like, more or less fluctuating the last couple months. So no, just because the rates went down a quarter percent doesn't mean your fixed rate is down a quarter percent. But if it's sustained and we continue to see a slight drop, you might see a little bit of drops on those longer term fixed rates. But overnight, you're not going to, like, the banks, and I know Rizwan's on the call, but I don't care. The banks are not going to give you like an immediate discount when the rates go down. They're going to sort of price it out slowly, and eventually you'll see something. But when the rates go up, like, by the end of the day, Rizwan sending me an email saying rates are up by midnight. Like, you better tomorrow we're cashing in. So, but that's just business. Like,
Yeah,
just
yeah.
seems logical that they would do that. So don't expect to see your rates immediately drop on the fixed side. But if you're closing in the next 4 weeks or more, 3 to 4 weeks or more, I would say, yeah, like, I think it's definitely worth trying to take advantage of that drop, because there's probably some spread there that you can take advantage of in the next week or so.
Yeah,
So
I kind
I
of
don't
think so. I'll let you quick one, and I'll let you jump in. I kind of think that if we get another quarter drop in July, and transactions start to pick up in the fall, I think there'll be some more competition for more mortgages,
yeah,
and then
the
the banks
margins
will
get
start to
better. Yeah.
yeah.
will start to
So
move, right?
so
Go
it's
ahead.
not. I don't even think the competition is going to have an effect on the rates,
Oh, really?
right? I
Tell
think
me more.
yeah, no, because bottom line is when it comes to lending, it comes down to cost of funds, right?
Mm.
I mean, what's your rock bottom? What's your profitability to your investors, right? And then what are you going to lend it at, right? And on in hindsight, you also got to take into account like how many lenders or competitors are playing in your sandbox, right? Because at the end of the day, we're a lender, we're still in business, right? So do you eat away at some of your profitability, cut your rates just so that you could get a piece of the pie rather than, you keeping your rates high for the sake of profitability and not getting any business in the door, right? So, once again, it's above my pay grade and the higher ups, the board, they make the decisions on it. But, over the last few months, even though the bond rates have gone up and down, we've actually dropped our rates. Our trajectory has dropped, right? And I think, don't quote me on this, Hugo, but I'm hoping over the next couple of weeks we're
Let
going to
me
have.
just record it. Let me record it. Let me record it so I can tell them. Okay.
I'm hoping, because we do have a little bit of flexibility on how we raise our funds, and I'm hoping over the next couple of weeks we will have another drop, right?
Yeah,
But
that makes sense.
yeah, to cascade or to paint all the lenders with the same brush and say, like Hugo mentioned, if you have 25 bit drop or the bond rate drops, that every lender is going to drop their rate. That's not necessarily true because it truly comes down to how the lender raises funds, right?
Yeah.
Their appetite, right? So yeah.
Yeah.
Fair. Yeah, okay. Well, I think that's been a good summary of kind of what's going on. I mean, maybe we'll just get some closing comments if you have any, just on, just for the investor who's watching this, like, do you have anything to say to them regarding today's rate or anything, just anything in general, and then we'll just say goodbye and close it out. Anything from you guys?
Well, for me, it would be, if you could take the risk and you can manage it over the next 6 to 12 months, pull the trigger, get the property, and just have a contingency. And, like we mentioned, have a reserve on the back end. And when you look at the housing market in Canada long term, it's always been a strong suit. Like it's always a long term investment. It's never a short term investment, right? So just
Absolutely.
have that confidence, right?
Yeah, yeah. I'll say quickly that, and I don't usually or ever quote this guy because I have no good things to say about him, but our buddy there, Mr. Trudeau, came out a couple of days ago and said something to the effect of, I don't quote, it's not exactly, but something that housing and equity in housing is most people's retirement plan, and that needs to remain stable,
Yeah.
which was very interesting. And I kind of like had to read it twice and like, is this summarized? Like, what's going on here? Because it's
Right.
probably the most logical thing I've heard come out of this guy's mouth. And we all know that that is most people's retirement plan in this country, especially the boomers who are actually coming into retirement and already retirement. The vast amount of their equity is in their house. And I think, it's probably just political on his end, but I'm guessing he's saying that because he doesn't want to disturb the nest as more than he already has with some of those people. So I think long term, everyone's got to be reminded that we're still in Canada. This is North America. We're going to have good years and bad years. Most of them are going to be good. But in 3 to 5 years from now, we're going to be looking back and saying, "Oh shit, I should have bought back then." And I know it's hard, and you got to get over your own emotions, but this is where it's at. You got a good team around you. You got people at the bank. You got mortgage brokers. You got people like me who know what they're doing. If you can manage it, now's the time, right? Hugo, you want to say anything before we shut her down?
Yeah, look, I'm a big proponent, obviously, in real estate. I'm in the business, so I guess selfishly, I've got a bit of a bet. But I would say, like, truly, like, and honestly, like, just get a good team. Get some people who are actually been doing this for a little while and can give you real honest advice and then guide you the right way and not trying to take advantage of the situation. Get a good team like you guys, get a good financing partner to put a proper plan together and give you real advice, and then just go for it. It doesn't have to be in Toronto. It could be in a smaller market. Just get into the market, I'm pretty confident anyone who's bought real estate that has owned it for 5, 10 plus years is going to be like, yeah, this is the best investment for sure. Yeah, the last 1 or 2 years, a bit messy, but that's kind of a blip in like the last few decades of real estate. And you have to look at it as a long-term play. But that team is needed to make sure they're guiding you to something that actually makes sense. Unfortunately, too often we get clients that are sort of like thrown into something that doesn't make any sense. And then their experience of real estate is very bad and they just don't want to do anything with it anymore. And that's that. So get a good team, figure out the plan, just get in the game. And I don't know, maybe this is my philosophy. Just don't overthink things sometimes too much, like do a little research, get a good team, let them kind of help you with some of the insight and just take action, because that analysis paralysis is a real thing. And I have a lot of clients that should have bought months ago, maybe more, and now they're paying a premium for that. So just sometimes just F it and go for it.
That's what we're here for. That's what we're here for. All right, guys. I appreciate it. I know you guys are busy. Rizwan, I appreciate you coming in from the bank. Hugo, enjoy your trip. And let's do this again soon. Hopefully every time there's a rate drop, we'll do this. I'm kidding.
Yeah. See you in a couple weeks.
Awesome. Thank you guys.
See you. Ciao.
Ciao.